Welcome back to Talk Tickers. You are tuned in to the show where we strip away the corporate fluff and get straight to the numbers.
And the spin.
And the spin. Today, we are looking at a massive ship that, after 2, maybe 3 years of very choppy waters, seems to have finally completed a long, complicated turn. We are talking Charles Schwab.
That's right. We've got the Q4 2025 results, the winter business update. And, if you've held financials, especially Schwab, for the last 24 months, it has just been noisy.
So noisy. Cash sorting, rate scares, the TD Ameritrade integration.
Exactly.
Yeah.
But looking at this print, the noise is finally fading. I mean, this isn't a story about some flashy pivot. It's really a story about volume, spread, and scale.
It feels like the all clear signal has been sounded, but I'm a little hesitant to say that because we've heard all clear before.
Oh, for sure. Only to get hit with another regional banking scare or a rate surprise.
But the backdrop does feel different now. The equity market's strong. Rate cuts are kind of baked into the cake for 2026.
The environment's shifted. It's gone from headwinds to, tailwinds.
Okay, so let's unpack this. The stock had a bit of a wobble on the headline numbers. Walk us through the snapshot. Was it a beat or a miss? Because it felt mixed.
It was a mixed bag, to be honest. Let's run the tape. For Q4, Schwab posted GAAP EPS of $1.33. That's up 41% year over year.
Huge growth.
Massive. But on an adjusted basis, they came in at $1.39. And that was a slight miss against the $1.40 consensus. A penny miss.
Oof. In this market, a penny miss can sometimes get you taken out back and shot. We've seen stocks drop 10% on less.
Sometimes, yes. But here it was. It was largely forgiven. Revenue was $6.34 billion, up 19% year over year. Again, a slight miss by about $30 million.
So they missed top and bottom line. Why didn't the stock tank? Why are we seeing green?
Because of the quality of the earnings. The market looked past that headline and saw the engine room healing. Net interest revenue NIR that came in at $3.17 billion, up 25%.
That's the critical number.
It tells you the balance sheet isn't bleeding anymore. Plus, trading revenue was up 22%. Volatility was their friend.
And the asset gathering machine, because that's usually the trump card for Schwab.
Still running red hot. Core net new assets for the quarter, a record, $163.9 billion.
For the quarter.
And for the full fiscal year 25, they brought in $519.4 billion in net new assets. That's up 42% year over year.
$500 billion. Just pause on that for a second. That is the GDP of a mid-sized country just walking in the door in 1 year.
It is staggering scale. And, the price action reflects it. Saw a pre-market bump. Stock closed up about 0.8%, around $101. It wasn't a moonshot, but it was a very steady affirmation.
Okay, so the sentiment is, the crisis is over. Now show us the operating leverage.
That's it.
Let's dig into that crisis is over narrative. Because for so long, the bear case was all about cash sorting. Remind us what that was.
Right. So this was clients taking their uninvested cash out of Schwab's low-interest sweep accounts and just moving it to high-yield money markets.
Which forced Schwab to borrow expensive money to run its bank.
Exactly.
Mm-hmm.
And that was the thesis killer for 2 years.
Yeah.
But that chapter it's effectively closed. The CFO was very clear. They have paid down the supplemental borrowings.
No.
The high-cost funding at the bank, that expensive debt they took on, is down to just $5 billion. That's the low end of their business-as-usual range.
So explain the mechanics for us. Why does paying that down matter so much?
It's all about the spread. When clients moved cash out, Schwab had to borrow from the Federal Home Loan Bank at, say, 5.5%.
Mm-hmm.
But their own assets might only be yielding 3 or 4%. They were losing money on every dollar. Now they're back to funding with cheaper client cash.
So the net interest margin just naturally expands.
Exactly. And the behavior itself, the cash sorting has normalized. It's just following typical seasonal patterns now.
It's boring again.
And in banking, boring is beautiful. You want predictable flows.
Right. But here's where it gets interesting to me. It's not just that the bleeding stopped. They're finding new ways to monetize. I was looking at the loan balances, and this feels like a hidden growth engine.
You're talking about the lending side. It's becoming a massive contributor. Bank loan balances hit an all-time high of $58 billion. That's up 28%.
And margin loans?
Exceeded $112 billion, up 34%.
I want to zero in on the pledged asset lines, the PLs. These have nearly doubled since 2023. This is basically borrowing against your portfolio, right?
Right. No selling, no tax event. It's sticky, and it's low risk for the bank.
But Is there a risk for the client? I mean, if the market turns and collateral values drop, are we looking at a liquidation cascade?
Well, there's always that risk, sure. If the S&P drops 20%, you'll see margin calls.
Uh-huh.
But these are usually very over-collateralized. Schwab is conservative with the loan-to-value ratios.
Okay, so the risk is managed. What about the growth runway here?
This is the shocking part. Management highlighted a statistic. In the ultra-high net worth bracket, the people who really should be using these, only 9% of clients have a PL.
Only 9%. That seems incredibly low for that group. The wealthy love leverage.
It's likely an education gap or just inertia. So when you look at the runway for lending growth, it's just massive. If they move that 9% to, say, 15 or 20, that's billions in high margin growth.
Without needing a single new client, that's pure share of wallet.
Which transitions perfectly to who these clients are, because there's this perception that Schwab is the boomer broker.
Yeah, that it's where your dad keeps his IRA while the cool kids are on Robinhood.
Exactly. But the data from this update, it kind of destroys that narrative, doesn't it?
It really does.
The average client age at Schwab has dropped by 10 years in the last decade. It's now in the 40s. But look at the new flows. Nearly 1/3 of new accounts in 2025 were Gen Z.
A third from Gen Z? That's hard to believe. What's driving that? Is it just the TD Ameritrade deal?
That's a huge part of it. Thinkorswim. It's arguably the best platform for serious retail traders. The young traders come for the tools.
So the strategy is a funnel. You catch them with a shiny toy.
Precisely. We call it the funnel. Get them in the door with trading. But the long game, as the CEO pointed out, is wealth management. 60% of those Gen Z accounts are new, but wealth flows are up big. Managed investing net flows grew 36%.
So the thesis is, come for the options trading, realize it's hard, lose a bunch of money, and then you click the button that says, Schwab Wealth Advisory, please help me.
That is the life cycle, and they monetize both ends of it. It's a brilliant capture.
Speaking of keeping them in the ecosystem, let's talk product roadmap. They explicitly mentioned crypto. Now, Schwab has been painfully slow on this.
Very slow. But management confirms spot trading for Bitcoin and Ethereum is launching in the first half of 2026.
Finally. Is it too little too late?
I don't think so. It's been a slow rollout, but it's very Schwab measure twice, cut once. They know clients hold these assets elsewhere. You can't force them to log into Coinbase to check their Bitcoin. You need it on the dashboard.
So it's a defensive move as much as anything. Prevents asset leakage.
Correct. And then for the ultra-high net worth clients, they're pushing into alternatives with the Forge acquisition.
Right, the marketplace for private security.
That's closing soon. This gives them the infrastructure to offer private equity, pre-IPO access. Again, it's about stopping those wealthiest clients from leaving for a boutique firm.
It's the democratization of private equity. Sounds a bit buzzwordy, but if you can offer pre-IPO shares to a client with 2 or 5 million, that is a huge differentiator.
And tying all this together is efficiency. They mentioned AI, of course.
Of course. It's 2026. You have to mention AI on an earnings call, or your stock automatically goes down.
It's mandatory compliance. But they cited 220 specific use cases. The stat that really stood out to me, though, was the result. Cost per account is down 20% over the last 5 years.
Wait, down, even with inflation?
Yes. That's the scale part of our theme. They're adding assets without adding headcount linearly. They're using tech to service them.
Which brings us to the jaws. We love talking about jaws. When the revenue line goes up steeper than the expense line, what's the guidance tell us?
The guidance is robust. Management laid out a scenario for 2026, assuming 2 Fed rate cuts. In that world, they see revenue growing 9.5% to 10.5%.
Double-digit revenue growth? That's healthy for a firm this size.
Touching double digits, yes. But expenses, only growing 5.5% to 6.5%.
There are the jaws.
Right. Revenue up 10%, expenses up 6%. That implies significant margin expansion. They're projecting pre-tax margins moving into the low 50s.
Low 50% margins. That is wildly profitable.
It's a cash flow machine. It implies a 2026 adjusted EPS in the range of 570 to 580. So upper teens earnings growth.
Plus capital returns.
Exactly. They returned almost $12 billion in FY25. You could expect that aggressive buyback pace to continue.
Okay, so healing balance sheet, younger demographic, new products, expanding margin. It sounds like a slam dunk, but I want to pivot because something came up in the Q&A that I think really defines the soul of this company.
You're talking about the prediction markets question.
I am. Someone asked about things like Kalshi, Polymarket, even sports betting, and CEO Rick Worcester drew a very hard line in the sand.
He did. He said they're open to financial prediction markets, maybe for hedging, But he explicitly rejected sports betting.
And he dropped a statistic that I think everyone should burn into their brain. He said less than 5% of clients who use sports betting apps leave with more money than they put in.
Right, and he contrasted that with the wealth creation at Schwab. His point was philosophical. Schwab is in the business of wealth creation. Sports betting is wealth transfer.
And it's usually transferring from the client to the house?
Exactly. It's a strategic signal. They're seeding that degenerate gambler revenue to the DraftKings and the Robinhoods of the world. They're saying, we want the accumulator, not the churn.
It's the difference between a casino and a bank. The casino makes money when you lose. The wealth manager makes money when you grow.
And they're betting that over time, the gamblers either go broke or they grow up. And when they grow up, they'll come to Schwab.
It's a maturity arbitrage. Speaking of maturity, what about macro sensitivity? What happens if rates crash? Is the nightmare back on the table?
The CFO addressed this. They have a hedge program now that's reduced their rate sensitivity by a third. They said even if rates drop to 2%, they still see 10+% earnings growth.
Yeah, so the rate cliff fear is largely off the table. They basically bought insurance.
It seems to be. The earnings power is much more insulated now.
Stable and predictable. Okay, we've covered the earnings, the demos, the philosophy. Now let's get to the part of the show where we pitch something a little wild.
And standard disclaimer, this is absolutely not financial advice. Do your own work. We're just connecting some dots.
Exactly. Don't sue us. But here's the trade idea. I'm calling it the house always wins eventually. Pair trade.
Okay, I'm listening. Walk me through it.
The premise comes straight from the CEO. 95% loss rate in sports betting. At the same time, Schwab is seeing record assets from Gen Z. The pitch is this. You go long Schwab, SCHW, and you go short the pure play sports betting names like the parents of DraftKings or FanDuel.
So you're shorting the consumer burn rate and longing the savings rate.
You got it. The novelty of legalized sports betting is wearing off, the losses are piling up, and you have a whole cohort of Gen Z realizing, hey, I can't retire on a six-leg parlay.
You're betting on regret.
I'm betting on reality setting in. You short the platforms, draining the wallet, and you go along the platform that's catching the survivors who realize they need to actually compound wealth.
It's a demographic maturity arbitrage. You're betting the dopamine hit of gambling fades, but the necessity of wealth management is eternal.
And looking at Schwab's growth numbers from people under 40, that migration is already happening. The kids are growing up. They're moving their money from the bookie to the broker.
It's a compelling narrative, especially when Schwab's valuation is based on steady compounding, while some of those betting platforms are priced for, infinite growth that might be hitting a wall.
Exactly. Long the adults in the room, short the frat house.
I like it. It's a risky, long-term thematic play, but it's fundamentally sound based on what we saw today.
So what does this all mean for you listening? Schwab is boring again. They fixed the balance sheet. They're capturing the next generation. They're expanding margins. In the world of financials, boring is where the money is made.
The ship is turned, the engine is humming, and they are picking up speed. With that guidance, it looks like smooth sailing ahead.
Barring any unforeseen curveballs, as always, that's a wrap on the Charles Schwab Winter Update. Thanks for diving deep with us on Talk Tickers.
We'll see you on the next print.